Hey, this is James Pelton here, a Friday morning here in the US. For US people, I hope you had a good Thanksgiving. We're excited here in the US. We're playing England in the World Cup a little bit later today. So we'll have to make sure the AMA, we have 3 hours until that game. So we have to make sure we're done by then because I'll have to go for that. But yeah, no, we won't be going that long. But what I need from you in the audience, please hit the like button. And then comment, you know what? This is something I've been wanting to know. Is Thanksgiving celebrated elsewhere or is it just US? I honestly have no idea. So comment below if that's something that's US only. We didn't do anything special yesterday, or if you do Thanksgiving a different day, or how it works in your country. That would be great. So we've been trying to get this AMA worked out for quite a while. So I'm really happy that we could make it work here today. Could you start out by just introducing yourself, and then we'll get going right into the project?
Yeah, sure. My name's Joshua Shigella. I've been in crypto since 2010, back in the day. One of the original Bitcoiners, and yeah, seen a whole lot of stuff happen. You know, FTX is just the latest. Of course, I fell victim to the very first Bitcoin exchange that got taken down, which was Mt. Gox. Back in the day, and that inspired me to create a transparency protocol for exchanges. We called it the Glassbooks protocol. We shipped it around. For some reason, exchanges didn't want to be truly transparent, so they didn't like it. And so we thought, well, let's build our own exchange and put it in there and be ultimately transparent. So we built Vaultoro through 2014, and we launched in 2015. And yeah, this was the very first Bitcoin physical gold exchange. And now, 2 years ago, I heard that Luna was coming, and I thought this is just another algorithmic stablecoin that's going to fail. And I started warning people. There's even video of me and Neville from Reserve up on stage at LeBitConf saying that one of these algorithmic stablecoins is going to get massive and then die like the rest of them, like BitShares back in the day. And there's nothing new under the sun with this stuff. So really, I came back after that and thought, I've got to create the ultimate stablecoin protocol that's fully collateralized, that cannot go to zero, that is fully backed, but without removing the keys and the structure from people. So not your keys, not your crypto, right? So yeah, so we started work on the standard a year ago, and here we are today. We're going to launch on the 28th, and so that's exciting.
Okay, all right. So we got about 3 days before we go here. So you have a lot more experience in crypto and in DeFi than a lot of my audience. So I think a lot of what we're going to need to talk about today is kind of education about why this is exciting, why this is important, why this is going to work when, like you said, UST didn't work, those types of things. But maybe let's start with here's what we're talking about today, the standard.io. Maybe you could start with just an elevator pitch, kind of a 10,000 foot view of what you kind of are setting out to build here.
Yeah. So the first step, well, the major vision, if we zoom right out and we can go back to the first step later, the major vision is to have a fully over-collateralized stablecoin where people can lock up wrapped Bitcoin or Ethereum or even tokenized gold into a smart contract, and then they lock that smart contract. So they still hold the keys. Nobody can access. It's not like BlockFi where you give them your crypto and they give you a loan. Rather, you lock it up into a smart contract, and then you can issue up to 85% of that value as a stable coin. So, but not only that, this is effectively a loan to yourself, right? But it's at 0% interest. So you can start to borrow money from yourself at 0% interest. Now, why would people want that? And by the way, there's no time limit to pay that off. So why would people want that? Well, let's say, back in the day when I had I had a lot of Bitcoin, and I would have to sell like a lot of Bitcoin because I wanted to put a deposit on an apartment, just the deposit for a rental apartment, right? And if only I could have put that Bitcoin into a smart contract, lock it, and generate myself a loan in a stable coin, and then pay the deposit. Now I'd still have that Bitcoin, and I could, and inflation would have paid off that debt for me, right? So that's the overarching thing, is that we need people to have a stable coin that's issued with real assets, rare numbers or rare metals. That's the key. And so yeah, that's the major overview of what's in it for the users to help us launch. is that how do we peg that at 0%? Well, we build a large liquidity pool that always buys back for the one, that always buys back 1-to-1. So how we're building that liquidity pool is you can come in on the 28th and until it's finished. And the very first liquidity pool, if you send Ethereum in, you get the very first S euro. That's the first stablecoin. By the way, we're building an entire suite of stablecoins. That's why we're called TheStandard as well. It's the standard in stablecoins. So it's S euro to start with, and then USD, Indian rupee, shekel, ruble, India, like just Australian dollars, Great British pound, all of them. And then we'll have a nice, beautiful FX market on the blockchain, which is also an amazing thing. So how people use it when they come in is to build this massive liquidity pool. What we'll do is we'll allow people to buy the very first S euro at 80 cents, so at a discount. And as more and more liquidity comes into that pool and fills up, that discount becomes less and less and less until we reach a 1. So 1-to-1. So 1 S euro equals 1 euro worth of value. At that stage, it's now considered a stable coin. And but while people are waiting, you've got you get an instant yield like of 20%, right? So it's like, wow, cool. I put 80 in and I get 100 S euro, cool. But no one in the wider world is going to give you 1 euro worth of value yet until it reaches a 1-to-1, because they could come to the IBCO and get the euro at 80 cents as well. So while you're waiting, you can actually put that liquidity, put the S euro with the equivalent amount of USDC into a Uniswap contract, and we buy that off you for a bond of a really high yielding bond. So and that can, depending on how long you bond that for, and actually you can go to dap.thestandard.io if you want to, so you can see the interface. If you hit that disclaimer there, and you have to, if you're possible,
all the steps,
yeah. So you'll see the interface here. So here's where you'll buy the very first S euro. So it's still on Gurley testnet at the moment. We're not on the Binance Smart Chain. It is on the Ethereum chain to start with because it has the most liquidity. But yeah, you'll be able to basically get a really high yielding bond on the second stage. So this is the first stage. So you'll see the discount curve there. So the very first people that get in will get it at 80 cents, and that discount will become less and less over time until we reach a 1-to-1 peg. And that helps basically two things. It gives you an amazing APY, but it helps the DAO build that liquidity to hold that peg. And then when you go, if you move up a little bit, you'll see the stage 2 there, S euro bonding. So there, what you can do is you take that S euro that you've just minted, and you also get take some USDC, and you approve those two, and you bond it, and it basically puts that into Uniswap liquidity pool, and for that you get a bond back. And right now it's still on testnet, so our devs are working on it. But you'll basically have 3 options, or four options actually, of different yield, different maturity times. So you'll be able to choose like 7 days, 14 days, 3 months, 6 months, or a year. And the longer you have a maturity, the higher the yield. But the highest yield is like, but including the 20% that you get up front, is like 65% APY. So or return on investment actually. So that's a really strong one. And then that gets paid back in the governance token, and you can stake that for even more rewards. Like so there's plenty of rewards to have. And our team is sensational, and I guess we can talk about that later. But do you have any questions? Because it is a bit of a complex thing there, James.
Yeah, no, I think that's good. So you're the plan is to get kind of initial people in with this big, huge discount that you get. So that will get kind of early people in. And then the plan to get liquidity is you offer kind of this bonding thing, and that'll fill up your treasury a little bit and will add liquidity, I assume. What's kind of the motivation for people who aren't in early? As you start getting up here, what's kind of the motivation to keep people? What's the pitch for them to keep going?
Well, the very early ones, they have to they get the highest yield because they're taking the most risk. It's a brand new protocol. We believe we're the best. We've got some of the best people behind us. Patrick Friedman, the grandson of Milton Friedman, is on board. We've got, we really have an absolutely stellar team. We're old school crypto people that understand the problems in this space, and we're here to build the ultimate thing. But so that's why a lot of people will get paid more in the initial phases, but by the time it fills up there, it becomes way less risky, and that you're heading towards €1. So you can, you still get a good yield of a few cents discount. That's pretty instant. So that's why people would do that. But yeah, maybe we'll cut it off at like 99 cents or something like that and finish it. But the main thing is to build that deep liquidity, because after this phase, after this IBCO, this initial bonding curve offering system, now we have a nice deep liquidity, and then we launch the smart vaults where people lock up funds by themselves. And there's some really interesting technology that we're working on that will allow people to mitigate like liquidations and stuff like that. So one of the big issues that's happened, especially through this bear market, is that people have locked up funds in like MakerDAO or something like that, issued themselves DAI, and then been liquidated. So we looked at that and thought, right, what can we do there to stop that, or to minimize that? Because it's just we don't want people liquidated very easily. So one of the things we're working on is, let's say you've locked up a bunch of money, you've borrowed some money to buy a car, and it's gone up in value. And you're like, wow, I got so much value there, but I've lost my job and I need liquidity. What can I do? Because I can't afford to pay back that debt that I took out. So what you can actually do to unlock those, you can actually sell that debt as an NFT. So we're now taking NFTs away from just pictures of monkeys and bringing them into the DeFi space. So imagine, I said this before to someone, that imagine in 2008, a lot of the blame for 2008 financial crisis went on to these CDPs. It's a similar thing, right? It's a collateralized debt position, but that was filled with housing subprime mortgages. Imagine if those were all NFTs, that you could look in and see which subprime mortgages they were. You could run some software on those. I don't think we would have been in the same situation, because someone would have, raised the flag more than just that one drummer from The Big Short.
Yes, right. Nope. That makes a lot of sense. So can you kind of talk about, so I think that makes a lot of sense, how kind of initial people are getting yield and kind of the bonding, that makes sense. Can you talk a little bit more about how it works for a user on the lending side of things, and like maybe walk through a customer or a user's journey of, okay, they get some of these tokens, then they lend them out, then they use them for staking or whatever. And can you just kind of walk through a journey for somebody?
Yeah, sure. So you mean through the IBCO phase?
Yes, correct.
The initial phase? Yeah. So the first phase is jump in, you've got some ETH, and you enter it and you buy some S-Euro at a discount. Now you've got a 20% up on what you've had once the S-Euro turns. Man, I keep hitting the wrong button here. Hit stop instead of snooze.
Oh yeah, man, those alarms, they're resilient.
Yeah, so yeah, now you've got a bunch more S-Euro than you should. So the value is not quite there yet. So while you're waiting for that value, you enter it into that bonding curve, and you choose, let's say, 30 days. And after that 30 days, you get a nice strong yield from that in TST, which is the governance token. And we can talk about the value of the membership/governance token behind this protocol. It's absolutely huge. I'm so excited about it. It's one of these things where we need to look at how DeFi products actually grow. One thing that I noticed being in Bitcoin since 2010 is that when I came to Europe for a little, like 3 years, and I came back to Australia, in that time I thought, oh, Bitcoin's going to be accepted everywhere. Nah, still nowhere. Guess what had been accepted everywhere? Alipay, which is from Alibaba in China, managed to just every shop. And I thought, how did they do it? Well, they had a strong business development team that would just go shop to door and onboard these people. So the real thing is to be able to build a protocol control value enough to also reward a strong DAO-based business development structure, so people could go out there and be incentivized to actually onboard new retailers to accept stablecoins in their local currency. So it's going to be absolutely magic. But when you take out a loan from yourself later on, you pay a little opening fee, like a minting fee. But then there's 0% interest. So I've actually had a lot of people saying, "Oh man, I'm going to pay off my card debt because I'm paying like 4%, 5%, some people way more, and I'll just lock up some liquidity into a smart vault, issue myself debt, pay off that debt. Now I'm paying 0% for the same debt, and there's no time limit on paying it back. So there's all these amazing things, but those fees that are paid in the network trickle down to people staking TST. So there's a yearly fee on the smart vault. There's a closing fee and an opening fee. They're not all there at the start. We'll make it very, without much friction at the start. And it all come from collateral, so it's very easy for people to deal with. And the other good thing, this is really cool. I'm really excited about this. If you're in a bear market as well, or if you're not, and you've got some collateral locked up into a smart vault, you can actually trade that collateral to something else. So you can trade it to, some other token. You can't get it out yet, but you can trade it to another coin, which is really, really cool. And for the best part is you can have an auto trade, almost like a stop loss. So if the market's crashing, you can also trade it to a tokenized gold. So that way, Ethereum might be doing crazy volatility, and gold's like, yeah, it's still volatile a little bit, but not as much. So you minimize that liquidation.
Okay,
Yeah.
no, very cool. That makes a lot of sense. Okay, so a bunch of questions, and again, I think a lot of what is going to be needed is education for people because they've seen things, like UST, and I like on your website you do a lot of comparing to UST because that's what people are going to be thinking about is, hey, we want to stay far away from this. We were hurting UST.
Yeah.
So maybe first thing we could talk about is once you kind of get up to that 1-to-1 peg, that's kind of the goal, right? Do you think what are the risks of that depegging, I guess would be the question.
Well, the risks are pretty much nothing because there is more value stuck in the stability pool than there are S-Euro floating around. That's the whole goal. You always have to be okay, let's step back a bit. How did Luna work? And this is what shocked me when I flew, the Bit conference, one of the biggest Bitcoin conferences in Latin America. It is the biggest Bitcoin conference. They asked me to talk in 2019 about stablecoins, and I went there and I read the Luna paper on the plane. And Luna had just launched, like it was still nothing. No one knew about it yet. And I, a few people were talking about it. I got there and I just couldn't believe it. I couldn't believe the crap I was reading. How it worked was just fundamentally flawed. So you have one USDT, UST, yeah. So one Luna coin that was pegged to $1, and they then backed it with their governance token. So let's say their governance token was worth 50 cents. They would just put two of these governance tokens underneath to back the one Luna. Now, if that governance token tanks in price to, let's say, 10 cents, they would just print 10 of them and put them in there and say, see, it's still worth $1. Now, in a bull market, no one notices anything, but fundamentally, the economics are totally flawed, and I spotted it straight away. Not because I'm a genius, by the way. It's because people have tried it before, and it's failed every time. So it wasn't like a new concept. And and by the way, guys, this is the beautiful thing about the crypto space is that we get to test economic theory. It's just you hope that it doesn't get to billions of dollars before people realize the test is terrible. But yeah, so the fundamental difference with the standard is to build a system that is backed by something that we cannot print out of thin air, that is backed by rare numbers and rare metal, meaning crypto and gold, and later silver, tokenized silver as well. So for all those long silver people that's still around on Wall Street bets and stuff, you're also involved. And Peter Schiff can get involved too.
No, I hope not. I hope we don't go that direction. No, this is awesome though. And I've thought that too. One of my favorite things about crypto is you can pretty much do all these economic experiments, all these things that people talk about. oh, we should try this in the US or something. It's like, well,
Yeah,
let's try it on a smaller scale in a crypto project. We can set up whatever economy we want and we'll see if it works. And so that's
that's
kind of
right.
what UST was. And like you said, that's been tried several times before and it just ends up failing.
Yeah.
When it's Ponzi-nomic at its kind of its basis and its core. So
Yeah,
uh,
it's Ponzi mechanisms built in with code. Terrible. They printed so much Terra Luna to back these coins that it literally made Venezuela blush. Like it's just terrifying. It's terrifying that that went so large. But yeah, the main thing that this was an inspiration for us, just like the Mount Gox collapse, which was the FTX of the day. This is what inspired me to create Voltoro, which was the like extreme transparent exchange because Ethereum didn't exist back then, so we couldn't create decentralized exchanges yet. So we focused on transparency instead. And so that was the answer to that. Now with Terra Luna, we really thought, right, we've got to create the ultimate stablecoin that's fully over collateralized, that's structured properly, that's got serious people behind it, a great team, and 0%. This is the problem with MakerDAI. They have a variable interest rate, so you cannot really plan for the future. You might take a loan out for like 0.5%, and then next minute it's like 6%. Yeah, what am I meant to do that? And that has happened. So I really don't like interest being at the base level of money. I don't mind it being like if I was to lend you, James, some money and ask for interest, I don't think there's anything wrong with that because there's opportunity cost. But at the base level where central banks are like lending, printing money out of thin air and asking for interest, I just don't think that's right. So yeah, so that's why when we're looking at building the new monetary system of the world, we don't want to have interest at that base level. I just think it doesn't sit well.
no, that makes a lot of sense. Can I ask? This is a side note, but what do you think about the MIM stablecoin?
I haven't looked too much into it. There's so many projects happening. I've just been focused on the standard. I couldn't say anything to it specifically. One of the things that we do want to work on though is making sure that the fundamental economics are right. But then the fundamental way we work with blockchains is right. So what our engineers are also looking at is cross-chain minting rather than using bridges, because I do find that bridges are a bit of a problem. If they get hacked, they can be they're large honeypots. So rather than sitting on Polygon, let's say, and locking up assets and minting S0 there, and then sending the S0 over to a bridge, over to Avalanche or whatever chain you want to be on, or BNB, or it's about like saying, okay, we're going to lock up here and mint over there. So this is a brand new technology that we're working strong on, and so there's lots of stuff happening that I think will really disrupt the entire industry and make it easier for people, because really mainstream adoption really is about, well, it's about trust, and the crypto industry hasn't done too well in that, even though we're the trust machine. But it's also about UX, UI, and all these different addresses and everything, and these bridges. They just make it terribly hard for UX. So that's what we're focused on as well.
Okay, awesome. And we do have a whole bunch of audience questions. And audience, I just have my questions I want to get through first, not because they're better questions, but I just want to make sure we get through them, and then I'll start jumping into some of your guys's. What about collateralization going down? I know that's sometimes a risk. Like MIM, for example, is a stable coin that's collateralized, but we just found out 33% of their collateralization was in FTX's token. So it's like, well, that's not their collateralization. They were over collateralized, but not anymore. Do you see that as a risk, with Bitcoin and Ethereum?
Well, the thing is that with the standard, sure, we have that initial pool of liquidity, and the DAO will vote where to put that. But generally, it's to make sure that there's liquidity for the S euro. So it's not really to be put into weird things around the web. And there'll be a lot of discussions of how to deal with that. But in terms of the smart vaults, once that's really how the economy grows. These smart vaults, nobody can access them. It's not like you put some collateral in that's I don't know, something like Ethereum, and somehow we as a protocol convert that to some weird Sam Bankman coin. Like it stays as Ethereum. No one can touch it. It's not Celsius. It's not BlockFi. It's your keys. So the only time it doesn't become your keys is if it under collateralizes and it liquidates, and then it'll basically be up to TST stakers. And we're also looking at maybe dropping it across to other smart vaults. So we're not quite sure. We're working on that. So if you have a smart vault already open, you might be able to also get airdropped some of the liquidated assets of others if you're staking TST. So there's lots of interesting stuff happening. But yeah, the key takeaway is let's go back to what old school Bitcoin was. Not your keys, not your crypto. Let's stop with this nonsense of centralized exchanges, centralized FI, legacy systems that are corrupt. We have to get away from humans dealing with our money and go back to code. Code is law kind of mentality, which is really, really important.
Okay, nope, I think that makes a lot of sense. So when we talk about liquidation, you talk about people taking out loans and then they get liquidated. I think when people hear that, they're thinking, oh, that's going to cause the coin to collapse. Do you want to talk about how liquidation of an individual affects the ecosystem as a whole?
Yeah, sure. The whole mechanism has to work in a way that there's always more collateral locked up than, let's just stick with S-Euro for now, but there'll be other stable coins, than there is S-Euro. So what happens if there's a liquidation? Well, we can't just liquidate those assets and still have the S-Euro floating around, because now there's less assets than S-Euro. So how it gets liquidated is people have to actually buy the liquidated assets. Yeah, it's slightly under market, under spot, which is great because it's a great deal for people buying those assets. But effectively, when they buy those assets with S-Euro, those S-Euros that they're buying it with get burned. And so now you've got less S-Euros in circulation and less collateral. So it's a mathematical certainty that there will always be more assets locked up than there are stable coins around. So it's about never allowing any sort of way to actually under collateralize. It's just not possible.
Okay, nope, good. I think yeah, again, just thinking about what people have been burned by in the past, and so what they're going to come to this project, what questions they're going to have.
Yeah,
So
bring it on. And this is really important, guys. This is what I love, is that in these bear markets, people ask proper questions, and that's what's golden about these. That's the caveat of these markets. When in bull markets, everyone look at what even what are they called? The big VC that invested in Sam, like
Almeida,
not Alameda, who was their company, but yeah. Anyway, these big VCs,
anyone, take your pick. Yeah,
these huge VCs just sitting there going, "Oh yeah, everyone's a winner," like not even doing the due diligence, and it's absolutely insane. So when these bear markets hit, people actually go, "Wow, that's what it feels like to be burned." Ouch. Okay, let's ask some proper questions of projects. So I'm actually really happy about it.
I totally agree, man. We are on the same wavelength exactly. Yeah, during the bull market, when I did AMAs, nobody cared what I asked. They were just basically the questions were, how high is the APR, and what's the minimum I can put in to get that APR? And then now in the bear market, people are asking much better questions. Again, just learning through their mistakes. Sequoia, is that who you were thinking of?
Sequoia, that's the one. Sequoia. Okay. Oh, he's playing a video game while pitching to us. He must be a genius. Great, for 150 million. Yeah. What? And I really want to point to Sequoia and say, you guys need a lot more scrutiny. You guys need a bit more pushback from the crypto industry, because when Sequoia invests, everyone stops doing due diligence because they figure that Sequoia has done the epic amount of due diligence on a project. And they obviously didn't. I mean, half a brain going over to Bahamas and sending one person just to have a look through the books would have notified, popped up red flags. Anyway, don't want to go too far into that.
Yeah, well, and it's crazy. I used to what you just said. I used to think that these like venture capital firms and hedge funds, that they used to know more than we do. But then I'm finding out, no, they invested in the same things. They got burned by liquidations when Bitcoin crashed the same way that average investors did. And it's kind of like, no, they're just doing the exact same things, but taking a fee. So
they honestly, the so-called smart money is so obviously not smart. They really, obviously there's outliers there that are very smart, but most of the time in bull markets, people go through hysteria. They go through hysteria just like the pandemic hysteria. Like it just people shut off their brains through either greed or fear. One of those two, they shut off. And so any sort of anything can happen when there's a full-on greed or full-on fear moment. People just run with the crowd, and this is really unfortunate. And for all those watching, when you're investing in these projects, check yourself during the fear and greed index. Use that.
Yep, absolutely, totally agree. We say the same things a lot. I think we would get along, and we should talk more often.
Yeah, awesome, man. Always here. If you're ever doing a show and just want to chat, we don't need to talk about the standard, but
Yeah.
I'll definitely be up for it.
Awesome. Thank you. I appreciate it. So let's talk about the use of the stablecoin. So is the goal, I guess I'm asking, why use this instead of USDT or USDC or BUSD? Is kind of the goal the lending part of it, or is the goal you're going to do business development and get a whole bunch of people to accept the standard as payment, or what's kind of the end goal that you're looking to do with this stablecoin?
Yeah. So first of all, we're looking to become a true standard, meaning that we don't just do USD. We do every major fiat. And have a coin for every major fiat. So then we can start to have an FX market of a mirror of the real FX market in the blockchain space. The second thing is that we've run a Bitcoin exchange that was only Bitcoin. We had no fiat. We had some other cryptos in there as well, but it was Bitcoin and physical gold. And an order book, and it would trade between gold sitting in Switzerland, high security vaulting facility. It was called Vaultoria. It's still there actually, and it's still running amazing. The thing is that we noticed very, very we had a lot of freelancers working for us, and they would always invoice us in Bitcoin. When Ethereum came out, Ethereum started also. And then all of a sudden in 2020, it was like Tether. And I was like, why are you taking this shitcoin? Like, why do you want this? I'd ask. And they always said, look, if I send another invoice to my accountant in Bitcoin, they're going to absolutely murder me, because the price has changed and they just, it's a nightmare. So I'd rather just invoice in my local currency. I get paid in my local currency, and then I can buy the speculative assets with those afterwards. And it's just an accounting dream. So as we move forward, and I'm seeing this also at conferences and stuff, people are like, oh, I've got some, like everything's USDT or USDC. It's all stable coins. The problem with USDC and USDT is they're centralized stable coins. We don't know what's going on there. They've got assets and liabilities just like FTX. So they could just collapse just like FTX. So the less we can put pressure on these, the less reliance we have on these centralized systems within the DeFi space, the better, because we're going to have an absolute calamity that makes Sam Bankman-Fried look like an angel if Tether collapses. You can have as much proof of reserves as you want, but if you cannot check how much money is in a bank account, it's intransparent, and they're running at legally at fractional reserve. So how are you meant to ever find that out? So basically, we need to remove those. CBDCs are coming, which are a complete hellhole in terms of human freedom. They're a complete nightmare. If anyone thinks that they will be good for anything, think again, because all they give you is instant settlement, and the trade-off for instant settlement is total bondage, a total control, total removal of any freedoms. If they decide, oh, there's an obesity epidemic, you've eaten too much sugar this week, you can't buy that, so your wallet just won't work if you wanted to buy a Mars bar, or a Coke or whatever. Like if hey, we have to stop, the CO2, the global warming. You've already bought 15 liters of oil, of gas this week, or this month, no more. These sorts of things happen with CBDCs. Why? Because what we're doing is we're moving away from having banks controlling that, and banks have a privacy policy with you. Courts would have to come in. Look, this person's doing something dodgy. There's protocols and steps. And then at the end of the day, what happens? The bank takes everything that's happened over the day, brings it to the central bank, and the central bank trades with other banks to clear the book. So one bank sent 1 million or 2 million to the other bank, and the other bank sent 500,000, they would only have to send the difference, and that's then clear. But the central bank doesn't know all the little trades that happen. It's like a layer 2 of the financial system. And so the ability to just move everything into the Fed, and where the Fed knows everything about every transaction, is a complete nightmare. And so when we're building something like TheStandard, it's about building something that is that is a bunch of smart contracts sitting in cyberspace. I refuse to call it metaverse. Sorry, folks. Sitting in cyberspace, and it's and they just work. They just work. If people want to use, and it generates stable cryptocurrencies, and it works as a system. So that's why. I think it's a very important protocol.
Okay. No, awesome. Yeah, no, I like a lot of what you said. Yeah, like the CDBC, the whole reason that crypto started was to get the banks out of what we're doing. And then we're, after a few burns here and there, a lot of people are talking about, hey, let's give the power back to the banks. They'll keep us safe. But it's completely designed to control and I've seen personally, I've spent a lot of time in venture capital, and I've just seen, hey, everything's designed for the rich to get richer and the poor and middle class to stay where they are or get poorer and funnel more money to the rich. And yep. Mr. C says the Fed is stupid people with a bunch of power over our lives. Yeah, I would agree with that.
Yeah.
Okay. Well, let's get to some audience questions. I've been ignoring them, but I don't want to. Yeah, I appreciate you guys being here.
Bring it on.
Let's see. Okay. What is the best manner of managing increased risk through increasing over-collateralization? Meaning, as risks increase in the marketplace, how does your product adjust to become safer for users? So we touched on that a little bit, but maybe we could kind of sum that up here for Matthew here.
Yeah. So if you have, let's say you've locked up, I don't know, 10 grand worth of assets into a smart vault, and it's sitting there, and you've borrowed, let's say, half of that, 5 grand, to buy yourself a car. And the collateral, like, you've lost your job. You're sitting there, you think, oh man, I need to get a new job. You've got 10 grand sitting there in value. You just need to pay 5 grand back off to unlock that value. Now, let's say there's a bear market and that value is sinking, and you're like, man, I just want to sell that. I can't pay it off. I just want to sell it and get some liquidity out. You can take that and sell it as an NFT, even on OpenSea. So someone can buy that debt off of you and then pay that debt off and unlock the collateral for them. So they just pay you to buy the debt off of you. And in the traditional financial systems, this is also a normal thing, except it's very intransparent, because a lot of the legacy financial system take collateralized debt positions, chop them up, rehypothecate them even at worst point, which means print them out of thin air, or they chop them up. They then take them to like a Moody's or some sort of rating agency who rate these things. You have to trust that rating, and then they sell them, and then those people chop it up again and mix it with other things, and you don't know what's in this stuff. So NFTs are amazing like that, as you can actually take this, sell it. People can look at exactly how much collateral is in that. So that's one way of dealing with it to gain liquidity back out. The other way is to actually trade the locked up assets yourself. So let's say you've got Ethereum in there, it's tanking like crazy for some reason, maybe proof of work didn't work out. You can trade that over to Polygon coin or something else, maybe some other token. But my big goal is to trade it over to a tokenized gold, because then there's these train tracks. If Bitcoin moves, the whole market's moving. Let's face it. There's not much diversification within crypto. Yeah, it's a bit of a speculation and a gamble, but effectively, if Bitcoin's going down, the whole market's sort of trending down. So what do you want to do? Well, you want to go into another bearer-based asset, another rare asset, which is gold. Gold is the perfect rare asset, and it's fairly stable compared to Bitcoin or Ethereum. So if Ethereum market's tanking, you can trade into a tokenized gold. Hey, presto, your collateral stops sinking like crazy, and you've lowered the risk of a liquidation.
Okay, nope, good answer. Okay, so we didn't talk much about the staking and things like that, other things that'll have available, but Where are the rewards being generated? So where does the money come from to pay
Yeah.
people either that initial 20% or the bond fee or the staking fee?
Man, these are golden questions. I wish people asked this about Luna. Like, hey, Anchor Chain, where are you getting this from? Oh, we're just printing it out of nowhere. Like, so thank you for these great questions. So, in terms of the general wide vision with the smart vaults and everything, what will happen is that when people there's a 0% interest rate, right? But there's a fee on minting. So when you mint the first S0 out of your smart vault, there is a fee to that. That fee gets trickled down and effectively airdropped on TST stakers. There's also a closing fee that'll be set to 0 for the start, and there's also fees, other possibilities. But then there's also ways of other fees that we're looking at. Let's say there's an alarm fee to say, hey, your collateral's getting lower. If you want to trade the collateral that's in your vault, maybe there's a fee there as well. So all of these fee structures and all of these things within the protocol are there to fund a little bit of the treasury, so the treasury can actually do business development and pay people to go out there and really grow the ecosystem. But it's also there to trickle down to TST stakers that are holding that and working on the protocol as well. So it's not something that they can just get out of nowhere. They have to do a bit of work for that, which means a little bit of staking. But yeah, it's all about finding those systems, and some of these systems like these fees can also be used to adjust any slippage that might be happening. So let's say there's a slight slippage in the peg, maybe. First of all, let's just say that if there is a slip in the peg, because there's more value locked up that you've locked up, you'd be like, oh man, I can suddenly pay off my debt for 3% off because it's slipping. So now you're buying S0 back off the market. That demand lifts the supply, lifts the price, and you've paid off your debt, and that S0 is now burnt, and you've got your collateral out. So there's all these mechanisms, but also these opening and closing fees can also be used as a little bit of pressure, which can be voted on because if there's an opening fee, obviously it's set at that time, but the DAO can vote to change that. Yeah.
Okay. Nope. That makes sense. And just as I'm thinking through it, so what happens on the opposite side of things if the price starts going too high? How do the mechanics work to kind of bring the price down? Like if you're getting, the price of the stable coin is getting way over, how do you keep that down? Can you just talk through that?
Yeah, I mean, generally what happens is the market deals with it because that's not necessarily a problem. Everyone's like, wow, more value. Wow. And what they usually do is they'd sell that to quickly grab that value because it wouldn't last long. That's generally what happens. If S0 goes above €1, then they'd be quickly buying, I don't know, things priced in euros like laptops and things.
Yeah, that makes sense. It kind of happened with euro and USD. The euro went down so much, and then all the US people were buying everything that they could get their hands on in euros, and then it had helped
Right.
balance things. So.
Right. Absolutely. Yeah. It's super fascinating.
Yeah. Economics is really fascinating, macroeconomics.
Yep.
Any concern about the SEC viewing this as a security?
We've got an entire legal team working with some of the best in the industry. So we're covering that. This is all about when you stake it, you also do a little bit of work. So it's not like a security where you don't do any work. The whole point of securities law is like you buy something and then you don't do anything and you get paid from other people's success. So this is all about you have to participate. You have to actually do work. Yes, it's not too much work, but you have to participate and do something, and that's what our advice is being told.
Okay, nope, good answer. How many people on your team, and are you guys getting paid?
Yeah, so there's 12 people on the team. Through the IBCO, none of that liquidity is going towards the team. It's all going towards building the liquidity pot, so that when you generate an S0, you can just send it back into that pot and get the ETH out or whatever like that afterwards. So, but we've we get paid from the initial sale. Like we did a pre-sale. We built some liquidity, and we've been paying the team from that. But also we've that's basically what it comes down to, is that we had a few sales up front, and that's allowed us to grow the team and build this out and pay for the developers and everything else.
Okay.
And
And
by the
then
way, this is all transparently available through and we're really hoping to the more, I come from the centralized exchange space, running Voltora since 2015. So it's been very difficult for me to step from being very, very secure. Like we haven't been hacked, knock on wood, since 2015, because we're just obsessed with security. Like we have lots of gates and things, no information leaks, and to take now that half that team and build TheStandard. And by the way, the Voltora also invested in us through and paid us as well through building this. But to go into a DAO where everything's open and everything has been has been really, really hard, because I'm so security obsessed that it's been tricky. But yeah, we're definitely getting there.
okay. And then Isaac wants to know, what's the weakness to the specific project? So maybe instead, I'll reword it to, what are the risks that you see could potentially happen with something like this?
Yeah, the risk, the risk is we choose maybe the wrong chain to sort of hitch our horse to, but even then we can decide to move the protocol over to something that's maybe more suitable. It's not a problem. I've talked a lot with the developers about that. Obviously, the anything in DeFi is risky when it comes to the smart contracts, because if there's a fault in the contracts, especially like smart vaults or something like that, that can get hard. But we have on board Hartej Sorny, who's pretty much the grandfather of smart contract auditing. Pretty much invented it in the space when Ethereum first came out. On board as an advisor, we've got just a stellar team, really, to make sure that that doesn't happen. The other thing is that one of the good caveats of Ethereum being so expensive is that you have to slim that code right down. So the smart contracts aren't full of bloat that could have bugs in it. Every single word in that code has been like stressed over to make sure it's even needed. And for that, you start to write really, really specific security attack vectors out of the picture, because and this is, by the way, this is the really important thing about chains that are super free, like super cheap. I don't know, because people just write really filthy, disgusting code because they don't care. They don't care. They don't care if the contract's like way over bloated, because they don't really know how to code, and they'll just deploy it because it's cheap anyway. Ethereum, because it's so expensive, you have to really optimize. So yeah.
Okay, awesome. We got just a few last questions here, and then I don't want to go over an hour, but a few last questions that I'd like for people to kind of have a final call to action here in a minute after we get through these few last questions. So that's kind of our agenda for these last 10 minutes or so.
Let's do it.
But Matthew wants to know, people don't trust stable coins anymore. It's kind of become a dirty word in the space. Have you considered coining a new term? Or another way to think about it, I think, is let's reconquer the word to actually make it mean stable coins and not unstable coins, is what it's kind of come to mean in the space.
I love it. I love the idea of rebranding. It's a very political thing to do, but yeah, unfortunately it has. But the fact of the matter is, if you look on CoinMarketCap, or if you talk to anybody that's freelancing in the space, they all want stablecoins. They want to be paid in stablecoins. It's just the thing that's being used as the actual currency. And Bitcoin and Ethereum and such are being used just to hodl and hold as a store of value, or a moonshot. So while I agree, I definitely agree, it's got a bad name. I want to make sure that we realize that there are different types of stablecoins. There's centralized stablecoins. Well, first there's CBDCs, which are a complete nightmare. There's centralized stablecoins, which are at least private and have some sort of need to stay good through a profit motive. But then you have algorithmic stablecoins, which are just nonsense backed by fluff. And then you have over-collateralized hard asset stablecoins like MakerDAO, like TheStandard.io. So there's a definite differentiator there between these stablecoin categories. And I think maybe that's what we need to focus on is, hey, there's algorithmic stablecoins and then there's, over-collateralized stablecoins.
Okay. Nope. I think that makes sense. So would DAI kind of be your number 2 stablecoin? Obviously, the standard is going to be your number 1. Would DAI kind of be your number 2 out of the existing ones?
Absolutely, we do most things with DAI. The only reason we're accepting USDC in the stage 2 is because it's just way more used currently for some reason. So it's just got a lot more liquidity. So it just gives the standard the best chance of growing.
Okay. I think, honestly, I think the naming is part of USDT and USDC's success. Is it just, I don't know, it's easy to remember, oh yeah, this is a stable coin. Whereas DAI, it's kind of
DAI, like what, who in their right mind would think, let's call it death?
DAI. Yeah.
Like what?
Totally.
I mean, I know it's not spelt the same, but still.
Yeah. And I would say of the DeFi experts that I talk with, DAI is the overwhelming, hey, that's the stable coin that we like. It's collateralized, not centralized. So
I like it. And DAI is actually coming to the same conclusions as us. I don't want to say they're copying us. They're obviously not. But they're coming to the same conclusions, which is really interesting, that they want to build a protocol controlled value pool and stuff. So, but some of the things that I don't like that they're doing is that they're going to depeg from the dollar to just be a unit that's somehow stable. But the problem with that is no one, if you're living in India, you want to get paid in Indian rupee. You know how much a carton of milk costs in Indian rupees. If you're living in the US, you know how much, I don't know, a bottle of whiskey costs in US dollars. You don't know how many units, so I don't like that. I don't like that they're buying government bonds and getting to some of these centralized sort of backing mechanisms. I think it's really the wrong way to go. I think the fundamentals of Maker and what they did in the beginning was so genius and wonderful. I really wish they would stick with that, but they're going in a different direction.
Gotcha. Ian says we must reclaim confidence in DeFi. Nothing wrong with the idea of DeFi or stable coins, just some historic users. So time for real people to run things properly. So
word up. Absolutely.
All right. Let's see. Mr. C would like to know, does that mean that there's a multi-sig in place, and will there be any persons who aren't on your team to move money out of the contracts to mitigate rug and hack risks? So maybe you could just talk about kind of the security around the funds and, exploit. There's good intentions, but then there's also exploits and things like that. So you want to talk about security on that side of things?
Yeah, sure. So because our team comes from Voltoro, we've always like the centralized exchange. We know security like crazy. Like I said, we've not ever had a hack. We've been around for 7 years. It's really, multi-sig is such a big win for the industry when that got released way back then. And really, it's about building out structures with multiple voting tiers and building these things. DeFi and DAOs in general are a very new concept. Nobody knows really how to do it properly. Of course, we're all learning. But multi-sig is a huge part of that, and now that we're getting into some really, really interesting technology where we can have vast amounts of signatures, maybe that's something that we can do with the DAO that somehow mixed with that with Snapshot. There's lots of really, really interesting tech coming around there, and definitely keep an eye out on the Discord, and let's talk about these different risk profiles. I think it's super, super interesting.
Okay, very cool. Well, let's go ahead and close up here with calls to action. So first call to action is free and simple. Just join the Discord, join the Telegram, follow on Twitter, and I'll put links to all those.
If you join the waiting list, there's like a massive giveaway if you invite your friends and stuff. If you get it into the 250 on the leaderboard, then you contribute €1,000 worth of value to the IBCO, then you'll get there's a whole bunch of different giveaways that we got there. Plus, it'll give you a chance to share and join these different things. You get points for doing all of that stuff.
Okay, awesome. So enter the waitlist. So if you go to the website, I'll put a link here, but there's this enter waitlist link on the side. I'll just show people just in case they're looking for it. But yeah, if you go over to this enter waitlist here, you can enter the waitlist, and then there's a referral program for bringing new people in and things like that. So that would be great. And if you have more questions, hop in Discord, ask some of those things. And then can you just remind us on when this is launching and what people will need to do to get in early on that?
Yeah, so it's launching on Monday at 2 o'clock CET time, so 1 o'clock Central, whatever it is, London.
The time zones are the worst.
I'm still on Greenwich time, it's definitely 2 o'clock CET. So get ready for that. But have Ethereum ready. What we actually, if you go back to the DApp, you can see the different tokens that we're accepting. But I can just say it's wrapped ETH, USDT, USDC, or DAI. You can contribute to the IBCO. And then have some USDC ready to bond that into the bonding curve, so that that helps us build out the liquidity, and you get a really great yield for it as well.
Okay, very cool. Well, awesome. Well, hey, I appreciate. First off, I want to thank the audience. Thank you guys for coming in. Thank you for your great questions. Thanks for listening. This one was more educational. It's not just a project pitch, but it's actually kind of a whole new way of thinking about DeFi pitch in a lot of ways. So thank you guys for your great questions. Yeah, it is super important. And then Josh, thank you for hopping on. Thank you for working with me on the scheduling stuff. I appreciate that. And reach out if you need tweets or anything like that, just letting people know, hey, this is launched now. I'm happy to get that out just to remind my audience.
Awesome. Thanks a lot, James. Thanks a lot.
Yep. Thank you very much. And go USA in World Cup.
Yeah, I'm gonna watch that. USA versus Britain. Wow.
That'll be a good one. It's like a revolutionary war 2.0
all over again, eh?
Yeah, that's right. That's right. So awesome, everybody. Hope you have a great Friday. Take care, everybody.